Okay, welcome back to Ultimate Trader webinar series. This is webinar 3, Timing, Exit and Entry. I think you're going to really love this module. This is really going to show you some of the real core elements that we're going to be teaching you in Supersized Trading Income about how to get into positions and how to get out profitably. Let's jump straight on into it. First of all, timing the entry. We're going to look to enter trades always following undersized bars. What do I mean by that? I want to make sure the bars on that chart are small. Must not be oversized. Why? If you see bars overstretched and racing either upwards or downwards in a very fast, volatile fashion, it means the crowd is involved. As traders, we never want to get involved in any type of position where the crowd is involved. We want to make sure we are only entering trades just before everything goes nuts and crazy. So we want to make sure that we identify that the trades on the chart are small before we even consider entering. That trigger point, therefore, is attained on the following. When the support and resistance is aligned, in other words, when resistance is becoming support or support is becoming resistance. In other words, when price breaks up through resistance, that level of resistance now becomes support. When support is being broken by price, that level of support now becomes resistance. In other words, when price breaks through a key level, that key level now would look to provide some support for it if it was breaking upwards, or if the price breaks down to that key level, it's going to look to provide some resistance. In other words, those levels will hold as barriers to price in the future. We're going to make sure that there's a pattern which has been recognized, and we'll show you that in later modules, particularly in Supersized Trading Income. We're going to go through that in real detail and show you exactly how to recognize the correct patterns to trade. We're going to show you how to evaluate the reward and the risk, and that's got to be we've got to make sure that the reward to risk ratio for trading stocks is always 3 to 1. In other words, we've got to make sure that there's 3 times the amount of reward potential to the risk that we're being asked to place, and that we have some agreement in terms of the time frame that we're placing. In other words, does the smaller term time frame, in other words, the 15-minute or the hourly chart or the daily chart, match the weekly chart? In other words, is everything agreeing, or do we have some incongruencies? So they're the really 4 key things for timing the entry. Then we're going to look at, well, okay, when do we squeeze the trigger? When do we press the buy button or the sell button? We've got to know the trade size. In other words, how much capital we're assigning to the trade. And we'll calculate that we'll show you how to calculate that, should I say, in later modules. In other words, by identifying how much reward there is in the trade, how much risk. And therefore, by knowing how much risk there is on the trade and how much account risk we're allowed to take, it then becomes a simple sum. So you can calculate exactly how much we should be placing on the trade to ensure we never risk more than 1%. And that's really our golden percentage, is 1%. We're going to know where the stop loss is and obviously how long we should be in the trade for. These are the 3 key things we need to be aware of. After we've entered the trade, we're going to make sure that we calculate, or at least note down, the fill price, and we're going to recalculate if necessary. In other words, if you got gapped into the trade a little higher or lower than you expected, we need to then recalculate where our real position is. We're going to measure the volume and price. These are very important measurements, volume and price, immediately following the entry. In other words, is it moving as quickly before the entry as after, or is it looking like it could duff out? We should exit immediately should the price hit a level that proves the trade has gone wrong. And it's going to be very clear for you to establish, because we're going to show up front where the stop loss areas are, where the trade should be going, and if it hits any of those core levels which proves the trade long, we'll be out immediately. Exiting the trade. The best exits come when we sell into a crowd just as the upward price action approaches resistance, and this is so key. In other words, when price is breaking away and really stretching up, this is when normal amateurs enter trades. This is going to be your signal to exit. You are not going to hold through and expect this to keep on going in one direction. We're going to get out before the retracement occurs. We want to be the first person selling into the crowd, not the last. We would only sit through a retracement if our trade plan is targeting several price wave, and hence we're expecting to be in the position longer. We must and we should expect a retracement if our trade plan targets a much larger move and a consolidation ranges forms after an initial move up. Then we would place a stop just below that range in case it moves the other way. The moment the consolidation is broken to the upside, we would then move our stop up. Let's look at some core risk principles to this. First rule, we're never going to enter a trade without first knowing our bailout plan. The most important thing we can establish up front is, where is this trade gone wrong? And when we've identified that area, we should have a stop loss there waiting to take us out should the price enter into that zone. We've got to measure our trade costs, including the real spread and the slippage, so we know exactly what we're facing here. Remember, a lot of those hidden details can often make the difference between a winning and a losing count. Okay, the second rule is to find low-risk entry positions. Why? Well, first of all, we're going to be entering trades which are very close to support and resistance, meaning whenever the trade is broken through a clear support resistance level and it's moving quickly and the volatility is picking up, it's too late. We've missed it. We've got to be getting into the position before that ever happens. So the first key is make sure that we're entering close to support and resistance. When the stock's pulled back following a decent retracement within an established trend, and when that trend comes back in to resume, that's when we should be entering. We're going to reduce our risk by trading entry positions following the undersized bars, never getting in when the bars are overextended. We should notice also that the spreads, the difference between the bid and the offer, the difference between the buy and the ask price, is less in a quieter environment. Why? Think about this. Your spread betting broker or any broker that's allowing you access to the market are going to widen the spreads in riskier, more volatile environments because there's no telling where things are going to move to. Their loss potential is greater when the markets are moving faster. When the markets are slower and quieter, the spreads will tighten up. So we're going to make sure that we look for less volatile markets for setups. The first and the last trading hours will carry increased volatility and risk, so we're going to look for entry positions mid-morning, or we're going to use a simple ordering system which will facilitate this for us so we don't have to sit there. The price penetration of levels is really defined when the bar closes through the key level it breaks and should then expand sharply towards the next barrier. That basically is the powerful system and basis of most profitable trade setups, and that is going to be our signal to enter trades. These important levels will both define our reward and risk. We'll look to buy at support when the nearest resistance is far above. We'd look to sell at resistance when the nearest support is far below. But first we must make sure that that chart itself hides no gremlins. Is there any missing signals that we're not seeing? And a single overlooked level could ruin what could otherwise be a perfect trade setup. So throughout Supersize we're going to show you exactly how to identify that and make sure that the map is clean before we go walk it. And that's a really crucial, important step to be aware of. Okay then, so trade entry, the calm before the storm. When we see that quiet sideways move, now we get excited. We don't get excited when the market's already excited. We have to do the opposite. When we see that nice quiet sideways range, we know that offers us an opportunity to enter a trade with low risk and decent upsides because we're getting in before all the excitement. Remember, when we see the excitement, we're leaving the party, not joining the party. That's the important step I want you to get. The uneventful and sideways range trading action are our triggers, therefore. The correct identification of these periods really allows for low-risk entry just before the crowd volume kicks in. When the crowd volume's in, we're leaving, remember. We use pattern recognition to identify these important turning points. We're going to cover those in Supersized Trading Income for you, so you're absolutely aware of what to be looking for, how to identify them, and then use some very useful scanning tools which will literally bring those trading opportunities to you every single day. The entry point, therefore, is when the undersized price bar ranges appears as the market approaches a level of stability. We're going to find a narrowing series of these bars in generally a sideways consolidation after a stock has pulled back a little from an existing trend. This is what we're looking for. When we find it, we consider the entry in the direction most favourable for the eventual breakout. Clearly, if we're in an uptrend, it's going to be long. If it's in a downtrend, we're going to be short. If the stock breaks out and starts to move upwards, then our game plan all becomes about how to manage the risk in the trade, which I'm going to show you in later modules. The real focus of those later modules is going to be, well, then how to then take the profit but keeping the risk low throughout the trade. Let's have a look at that exiting the profit and putting some stops in place. First of all, taking the profit. The best time to sell will come when you sell into the crowd volume. Remember, this is when everybody else is buying. We're selling. We're coming out just as everything goes crazy. Why? Because when we have a volatile, exhaustive move upwards, we tend to see a counter strike where the market moves rapidly in the opposite direction. We want to be gone before this ever takes place. The best time to sell, therefore, is when there is oversized bars. Look at the size of those bars stretching upwards. That's when most people are entering. This is the time to be leaving. When we see the volume picking up and the number of shares changing hand, this is when everybody and their dog is placing trades. and when we're getting close to that level of resistance. Don't wait for it to hit the resistance. We've got to be out before we get to resistance. 60% of the move. I hope you enjoyed this module. Look forward to speaking to you in the final modules of this webinar series, where we're going to show you not only how to take profit like we have done here, but keep the risk low throughout the rest of the trade. Remember, the best traders are those that put risk first, taking profit second. Remembering that our primary objective is not just to make profits. Our primary objective is to keep our risk low and to protect ourselves. Our real primary objective is to get our trade to approximately break even as quickly as possible, so we know that the majority of the trades that come through, if they don't work out, we lose very little. And then that leads the landscape for the big profitable trade to come in and seriously put our account in profit. Look forward to seeing you in later modules.